You say it's not about fundamentals, it is about market signals. What are your convictions?
So at Dimensional, we focus on long-term drivers of expected returns that exist in the market. And when we say market signals, that means the information contained in the market price tells us a lot about long-term expected returns and the drivers of long-term expected returns. And those are the things that we believe that deliver the results over long term for investors.
So what market signals are you looking at in particular?
So there's a number of them, and these market signals are first discovered by academics back in the 60s, 70s, and continued ongoingly. And they are basically trying to study what the market price is telling us about returns, long-term returns. And for example, there are few in the equity market exist. Smaller companies, smaller market cap companies tend to deliver higher returns than larger companies over time. Relatively low-priced stocks tend to deliver higher returns than higher-priced stocks. And then more profitable firms tend to deliver higher returns. And these are well documented by academic research over the past decades.
So fair to say that whatever fundamentals there are right now, there will always be assets to buy in every market.
We believe so, and that's part of the belief that market is a great mechanism that sorts through these information. You know, whether it's company fundamentals or macroeconomic information get reflected in the market almost instantaneously. And so that market price reflects these information, and that price tells us what are the higher return securities that investors should focus on.
You talked about the equity market. How about a fixed income market? I mean, what signals are you reading and how are you invested?
So for fixed income market, it's similar to equity market. There are long-term drivers of expected return exist, and that's reviewed in the market price, or in other words, in the yield curve that get priced all these bonds. And specifically, we focus on two of them over time. One is the term of the bond, or how long the bond is, the duration of the bond, so to speak. And the second one is the credit quality of the bond. These are drivers of long-term returns that we focus on.
Now, that leads me to ask how your portfolio looks like. And over a period of 30 years since the company was formed, what have your returns been?
Sure. So our company is founded in 1981 and it's been in existence for 38 years. And currently we manage around $600 billion globally on behalf of our investors. The philosophy since day one has been focused on these long-term drivers of returns. And that hasn't changed over the past 38 years. And we are able to deliver very good results for our clients and across all of our strategies, both equity and fixed income. In our equity strategies, we invest in 40+ different markets, and our strategies are very diversified, low cost, scalable, and low turnover in most cases. And in the fixed income space, we invest in 20+ different markets, and in a very similar type of fashion, low cost, scalable and transparent.
How do you view commodities? How does that factor into your portfolio?
Commodity is a specific investment. We have a small amount of investors. I should say we have investors that invest small amount of, relatively speaking, into commodities, and we do have bespoke commodity strategies built for those investors and invest into the commodities market. And depends on the need of that investor, commodity could play an important role in their portfolio.
I'm curious, how do you view risk? And related to that, what's your play on gold, which is often seen as a haven play, a hedge against the risk?
So risk actually is a very important topic. And if you look at long-term returns, risk and return often come in hand. So risk is almost inevitable when you are dealing with investment. What we think the more important thing is, one, how do you define risk as the investor? And then secondly, how do you deal with risk over time, over a long period of time? What we believe the right way to deal with risk is to understand your risk appetite and then build the right portfolio that fit in that risk appetite, focus on long-term driver return, control your cost, and control the things you can control, instead of worrying about the other factors and such as gold and so forth.
Investors now look at the low rate environment and trying to decide where to park their money. How do you consider, one, this low rate environment, where the Fed is headed? I mean, do you even take that into consideration when investing?
So I think it's important to understand that a lot of these environment are the Fed decisions, so to speak. These information get reflected in the market price in seconds. And so the market price already contains these information. And for investors, we believe it's better to focus on what I said before, these long-term drivers of expected returns, and control what they can control, rather than second guess the market. What's the market's going to do? What's the Fed going to say, this morning or tomorrow? And those get reflected in the market already.